The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions bored of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Another day of volatility so far this week. It has been a rough go. The month of August, really, I'm not a fan so far of the month of August, and it's my birthday month later on in the month. You'd think I'd be a little happier, but these markets have kind of got me in a down mood right now. A risk-off day in general. Grains, livestock, energies, the stock market. There's a lot swirling around the trade right now, and happy to discuss all of that today here on the program. Joining me now, Mike Zuzolo with Global Commodity Analytics. And Mike, great to have you on the show today. I know we got a lot to talk about just in general. Man, this has not been a fun couple of days throughout this grain, livestock, energy trade, stock market, everything. Just negative tones across the board, Mike.
Yeah, and it's interesting because off of last week's highs, even though we're talking a lot of weather, and even though we're talking about a lot of bombings again between Ukraine and Russia, soft red wheat is the percentage loser since the last week's highs were made, whether you're looking at lead month soft red, lead month corn, or lead month beans, Jesse. We're down about $1.40 in soft red wheat from last week's highs to today's, Wednesday's lows. But that ends up being an 18% fall, and that compares to soybeans, which has only had about a 10% fall, even though it's been $1.60 for their break. And corn's had about a 14% fall. And so what you really want to start thinking about is the funds versus the fundamentals here in the marketplace, and whether we're trading funds and money or whether we're trading real fundamentals. And my go-to chart for the fundamentals is the cash price of wheat around the globe. And that's what we're looking at here today. And you can see in this chart very clearly the red line is the France Paris price of wheat. I believe it's in Rhone, on the Rhone River. But look at how much it's declined since the end of June. And it is now matched up with the U.S. soft red wheat, which would be in the orange. And this just goes back to what you and I have talked a lot about, that we got to have a low in the European markets, and the French business has got to come on before the funds get off the negative sentiment that we're on. And I think that is the vast majority, along with the Federal Reserve policy, staying in a hawkish mindset, the European central bank staying in a hawkish mindset. These two classes of wheat, or these two countries' wheat, continue to club each other over the head.
Well, and I see something on this chart that is interesting to me just as an observer here, Mike. We've heard a lot about this cheap Russian wheat, and you talk about that French wheat coming down here, getting a lot closer in value to Russian wheat. So to your points, that's just an interesting observation for me as I look at this whole picture here, Mike.
You've got a great eye, because we had an Egyptian tender, and it was a big tender. I believe it was 360,000 tons. And we're seeing Algeria, we're seeing Tunisia, we're seeing Egypt come in, all for wheat, some other countries coming in for corn. So the end users are moving because of what's happened in the Black Sea. So that's the first step to have happen. But that Russian price of 240, Jesse, the Egyptian price delivered, Russia got most of the business. Romania got a little bit, but it was 250. We're thinking that that is the new implied floor price for Russian delivered wheat, because they are over a third harvested and their yields are down from what I'm hearing, 4 to 7%. So we'll just call it 5% in the early stages of their harvest. And so that's one piece that's on this chart you picked up right away. The other piece, and the last thing I'll say, is notice the very lowest price is the Ukrainian wheat price at 185. This is a weekly price. Notice how we're not getting bids out of that port in Ukraine that this line represents, this price represents, going all the way back to 2 or 3 weeks ago. That is the rub that I have with the funds and with the market right now, is how can you be talking about peace when you go to a 10 or 12 country peace party negotiations this coming weekend, and I think it's in Saudi Arabia, without Russia being part of it? How can you assume that Russia is going to come in and go ahead and rejoin the grain initiative when they're continuously bombing key grain facilities along the Ukrainian areas of the Black Sea, so much so that we're now seeing those prices are not bid. They cannot get insurance, they cannot get ships, and you can see just this, the most recent damage from overnight on August 2nd, and a big port of Ismail, I believe how it's pronounced, that was damaged. That's along the Rhone port. And, you know, you've got major facilities now being hit. That those two pictures total are, they're suggesting 40,000 tons of grain that's lost, much more from the pictures I've seen when it comes to actual physical infrastructure that can store grain. But those ports are closed now. So you've got Odessa, the crown jewel of the Black Sea, really not doing anything at this point. And yet the trade continues to blow off this mindset that we're going to go back to the table between Russia and Ukraine.
And it's just, there's a lot tied into this here. And I'm with you with your thoughts on the peace talks. If you don't have Russia involved, I don't see how Russia is going to stop bombing these port facilities. And I just feel like the war is going to continue here, Mike. But we look at all of this perspective wise here and throw it into the vacuum of the markets, I feel like, a little bit. And it seems like that unless there is enough headline news, these markets, for whatever reason, just are not trading the situation. They did it for a couple of days, and now we're kind of whistling by the graveyard again here, Mike.
You're right. We're doing it in other markets too. You know, just this is brand new news as of Wednesday, Tuesday night. We had Fitch come in and downgrade the U.S. debt to AA+. That joins the Standard & Poor's, which did it, I believe, over a year ago now. It might have been during the pandemic even. So there's only one real big ratings agency that's got us AAA, and that's Moody's. But instead of the dollar breaking hard and the U.S. bonds and treasuries breaking hard, the U.S. dollar went sharply higher, and some bond markets in the short duration actually went higher. And so, again, this disconnect, you can see it all over the place. And I really do lay it at the feet, Jesse, of the central bank policies. We've had big moves by the Fed, by the European Central Bank, and now Japanese, the Bank of Japan, has now done a 180-degree turn on their policies, and it's creating, I think, a major move in the money, and it's really creating an environment in the commodities, especially those commodities with already weaker demand and weaker export bases. It's creating a real strong environment to stay out, if not get short.
Well, another issue here as well, Mike, is weather. And of course, we've been talking about how hot and dry things have been. Now we're seeing rain moving through, and we have a wetter and cooler forecast. But we got to think about what damage has been done. I think about corn, and I know you shared some photos with me as well. Here, we'll pull these up on the video feed. There are issues out there in the Corn Belt that I'm not so sure we're completely talking about in the market right now, Mike.
I think that's 100% correct. I don't think we are talking about it. I think we're actually kind of like the wheat in the Black Sea. We're whistling past the graveyard right now with the idea that we don't need the demand. And that's what eventually works us into a food crisis in 2024, Jesse, if we don't have good crops. But that previous picture was from a client in Waterloo, Illinois. I had barely gotten off the phone, and he texted those to me. I'd barely gotten off the phone with another client from Olney, Illinois, which is probably 2 hours almost straight east of Waterloo, which is south of St. Louis. And he had said he'd been walking his field, seeing heavily diseased corn, lack of nick and pollination, and severe tipback. I think these numbers of 49% good to excellent in corn in Illinois are not being addressed by the trade right now, because the trade is not really willing to say we're below last year's yield at this point. The picture you see here came last week from Kansas State Agronomy. They put out a special update on the loss of a big tip back and loss of fill in corn, partially due to pollination before flowering, abortion there, and then abortion after pollination, both less than 10 days and 10 to 25 days. A big issue in the abortion after pollination in day 10 through 25. You notice how the corn was just completely dried out on the second right-hand side picture. That was almost 100% due to the heat that we've experienced in parts of in the Western Corn Belt. And I would say while Iowa was a little bit drier, a little bit cooler, not enough that I don't think it does not have some tip back in it as well. So I've got 9 of the 12 states that I look at for corn yields. I've got 9 of those 12 staring me in the face with either the 4th worst year in 5 or the 5th worst year in 5 when it comes to good to excellent conditions. And that would include Minnesota, Iowa, and Illinois. And obviously, Nebraska is still worse, near the worst in the last 5 years, and Kansas is 4th in the last 5 years. So I can't get above 173.3. I'm moving my yield down into the upper 171s, low 172s as we head to the August 11th crop report.
We're having a conversation here today with Mike Zuzolo from Global Commodity Analytics. And Mike, as we take a look at just everything and think about all of the items that are wrapped up in our trade right now, and we look at all the volatility, the rallies that we've had here over the last, say, 3 months, 4 months, where do we stand right now? Because I feel like, we keep having a rally and then we go back and retest support underneath these markets, and we just keep bouncing off that. So in your eyes and the analysis you look at, I mean, where do we stand? Have we really done anything in these grain markets? I feel like we've just been yo-yoing in a range here.
Well, and I think your feeling is justified because it feels like that we have just collapsed this market in a way, and that's going back to last week's highs or last month's highs. We could not find follow through. But if you take a step back, and this is where I think it really helps when I do these kind of charts and this kind of analysis with you, Jesse. I think it really helps the clients and the producers out there to see exactly what's going on. They don't have to listen to you and I, especially me. They can just look at a chart like this Bloomberg Grain Commodity Index, which strips out all the ag sectors except for the grains. And you see we have tried to go higher, but essentially have not really done anything but stayed in the same range we've been in since mid-2022. And that's really striking to me when I look at that. And we're still right there at that wedge point, back at it right after 2 months in a row we've tried to break higher. We're still developing in those bottom lines, those red and green lines, those slower stochastics that I've tried to optimize with major highs and lows and prices. We're still looking at a potential buy signal on this monthly chart, even with all the negative price action we felt and that we've seen here, whether we're looking at the last week or maybe the last 30 days.
Well, and overall, to kind of wrap up our grain talk here, Mike, obviously, I've heard a lot of disappointment from some farmers as this market has collapsed here in recent days. They maybe didn't sell as much as they wanted to, kind of the age-old, story that we hear all the time. But have to think here as we get back down around some psychological support levels and some technical support levels here that it's a good area to manage some risk here, Mike.
Yeah, and I think this is where the demand side of the equation really comes into play, even with the demand that we're talking about. And we're looking at some of the best demand in the world wheat market and consumption in world wheat that we've seen in 15 or 20 years. But even with the demand that it seems so negative right now, Jesse, I think it's still very hard to see a corn ending stocks number above 2 billion bushels this year. Mm-hmm. And I think especially what's important here with wheat being our leader in percentage terms down, we are still going to have a 7-year low on world wheat stocks. We're going to have a 9-year low on world wheat stocks to use ratios. Those are USDA's numbers, not Mike's. So unless I see those numbers change and they get better or larger, the market is still going to have to come back to a very tight supply situation, as much as a decade tight supply situation. And that's why I talk about the food crisis potential.
Let's talk livestock here, Mike, and let's start with feeder cattle. This cattle market in general here, it was lower Wednesday, kind of along with everything, just a risk-off mentality. But I know last week we never really saw a whole lot of cash activity developed, the market felt choppy, and we just look at how things sit right now. Walk us through this chart first, and let's just talk feeder cattle. I mean, what's your thoughts with where things stand here as we kick off the month of August?
I just got done doing a special report talking about a Q4 recession here in the United States, and I think that China's already in a pretty significant recession. The most recent numbers from China this week, this debt downgrade from the United States, those things are supporting my analysis. And what that analysis would suggest is we have not priced any premium in on the grains. We've talked about that. We've priced a lot of premium and a lot of fund length into the meats because the demands remain strong on decreasing supplies. But we have to be nervous if we do go into a recession, A, what the funds do, and B, what the consumers do, especially consumers in Asia, because our exports for beef and pork have remained very, very stealthy and very, very stalwart. So what I wanted to do was, we've already taken out the feeder futures highs from 2014. That would be that October 2014 high of 245.20 in the future. So I wanted to go back and try and get some leading indicators that I could use, maybe of when do I think the funds are going to pull the plug, when maybe do we have a cycle high in place. And I was very surprised and kind of happy to see that the feeder cattle cash index that the mercantile uses based upon a lot of the country price action has not yet taken out its 2014 high. Today, on Wednesday, it got within about 30 cents of 244.99, that December 2014 high. Once we take that out, I think that's the first warning signal that we're probably going to start running out of buyers, and we're probably going to be getting into thin air territory. So that's one of my triggers. This is usually what I'd say to clients and producers that I work with, but I wanted to give some of these people that are loyal to you a freebie today. This is going to be one of my triggers to recommend fresh feeder sales, and haven't done hedges for a couple other reasons that I'm not willing to share publicly, but this is a third reason now that I found it.
Well, and great thoughts, and I know our listeners and viewers do appreciate some of those nuggets of wisdom here, Mike. One other thought I wanted to run by you as well, just when I mentioned the lack of cash trade last week, I wonder if the heat stress maybe had an impact on the lack of activity in feedlot country last week.
I think so. And I think also that the producers were probably, the sellers, the feedlots are probably wanting quite a bit more than they could get at that point. They're thinking that we're going to see the Packers come in hard for that last grilling summer season weekend. And we may get that yet at the end of this week, first of next week. I wouldn't give up hope yet, but after Tuesday, Wednesday of next week, probably would start moving, just because that heat's supposed to be coming back into some of the key areas of feedlot country.
On the hog side, I know August hogs still holding close to the cash index, got about a $3 premium with the index right now, and August hogs are running out of time here before expiration. But you look out at some of the deferred months, and we're still holding in the $80 range. I have to wonder if maybe some worries about Prop 12 are in the market there potentially. What's your thoughts on hogs right now?
Yeah, I think that's exactly right. I have two things I'm watching for the front end to be leading the back end at this point. One is the domestic belly market. It's now peaked up towards the 2021 high and the 2022 high. Both of those came in early August. We've matched up with the 2021 high of about 235 on the bellies. Once we see a belly peak, I think that's a strong indication we've got a seasonal high in the hog complex. The bellies are what have kept those cash markets running stronger. That maybe is the most negative feature to the market right now, Jesse. One of the uncertain parts that could be a very positive feature down the road in those deferred markets, and why I probably wouldn't sell the deferreds yet, is because the big heavy rains that we've seen in northern China and north central China. Those are big hog and chicken areas and grain areas. I want to see if we can find out if there's some production losses in agriculture in those areas, because we're talking about record rains. I think Beijing and that surrounding area had even bigger rains than they did during the historical century mark of back in 2012. They had even bigger rains than that this past week, and I think more is coming with some more training effect of some more typhoons. So that could really disrupt the supply over there in China. That's a big wild card, I think, in about a month from now.
Mike, we covered a lot today. Anything final you want to share with us or reiterate to folks before we run out of time?
No, just sign up for a subscription. You know, skip the trial if you can, and sign up for a subscription and get that special report on the macro and the micro, the funds versus the fundamentals. I think if you read it and you integrate it in your marketing, it can do some good.
And where can folks find subscription, trials, phone number, more? I know they can find all that online, can't they, Mike?
Yes, globalcomresearch.com. It's globalcom with two M's research.com. And don't forget to take a look at the product services as well on there.
Fantastic. Mike Zuzolo, Global Commodity Analytics. Always great to talk with you, my friend. Have an awesome week, and we'll talk to you again next week.
Jesse, I appreciate you having me. Thanks for having me again.
That's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.